So another couple data points from the US showing a big hit to the job sector and the growth sector in the US economy. We got the ADP jobs numbers coming out way less than expected. The number came out around 37,000, which is lower than the expectation of 111,000 jobs. So only about 37,000 jobs were added in the ADP employment change number, way lower than the expectation. And the previous number was also revised lower from 62,000 to 60,000. Now, when you look at the ADP numbers, it's been mostly ranging the start of 2023, and it's been in between 89,000 to about 84,000, but we finally started to see a crack below in the last numbers when we got 60K and then now 37, basically coming down the trajectory, going lower and lower. And it looks like it's about to go into negative territory. Now, that is to be seen, and we'll wait and see when that happens, and if it's going to come anytime soon. But definitely we did see the triple digit numbers of 100K plus back in 2021, 2022, 2023, 2024 especially. And those numbers significantly decline, where you're now seeing the double digits of 77K, 62K, and now a very low numbers, 37,000 jobs being added. So it looks like the trajectory is just getting lower and lower, where less and less companies are hiring. And we're hearing that from central banks, where businesses are basically being more cautious than expected and are not hiring as aggressively as they were before. So they're pushing back on the hiring, and actually some of them, many of them are even laying off workers. So 37K, not far, from the zero bound and even getting into negative territory. So let's see how this progresses, especially heading into September, October, where September, you tend to get some volatility in the markets, and things tend to change around that time. And so let's see what happens there. But definitely, not an amazing sign here. And like we've been talking about on this channel multiple times, we will see eventually where the data points show its true teeth and the true colors. We also have non-farm payrolls coming up this Friday. So with all the jobs numbers that are coming out and the data is coming out, it looks like it's pointing towards a weaker non-farm payrolls report. So, but let's see. We will see when Friday comes. Aside from ADP, we also got ISM manufacturing numbers telling you about the growth story, the manufacturing sector in the US economy, coming in lower than expected at 49.9 versus the 52 mark. We also had new orders drop aggressively to 46.4 versus the 52.3. What's very interesting here is we got ISM manufacturing prices moving up higher, 68.7. So you got growth weakening in the US economy and inflation prices ramping up. And especially if you look at the ISM prices and you look at its chart and historically how it's been playing out, it bottomed around the early of 2024, and we're seeing quite the steep rise now in ISM manufacturing prices, bringing it back to 2023 levels. And if we break these levels, we could see even highs like we saw back in 2022. So inflation is picking up, and we're seeing it in the manufacturing prices component, which is eventually you're going to see it in other parts. When you go to the grocery stores and you go to make purchases, consumers are already feeling it, but will continue to see that get worse off, right? So that's why you have the Fed and also Bank of Canada today pausing on rate cuts, because due to the tariffs causing the prices to pick back up again. So, you know, we will need to see, if you want to see lower prices, it looks like we're going to have to see higher prices again in order to get lower prices, because those higher prices again might break the back of the economy. It's already breaking, but might break it further, which may cause those job losses and the plunge and that so-and-so recession that we've been talking about and everybody's been waiting for quite some time. Now, what's very interesting with all this that's coming out, you know, yes, you're getting the reaction in the bond market and those yields are coming lower, moving lower, but the stock market has been shrugging it off over and over and over again, regardless of how bad the data is. Because two reasons. One reason is Taco Trump. Taco Trump, if you don't know, Taco stands for, it's a term that Wall Street came up with, where it stands for Trump always chickens out. TACO. Taco Trump, right? So we remember when Trump put out all these tariffs here, we're seeing him back off. And the reason he backed off is because the bond market was plunging along with the US dollar, was melting lower, causing those yields higher. And if you break the US bond market and the world reserve currency, you probably messed up in a very big way, right? So that's why we're seeing the softness from Trump and this Taco Trump trade, where every time we get some bad news or we hear Trump acting like a bully again, the dip gets bought up. And as I'm speaking right now here at 11 a.m., we do see the dip getting bought up in the equity markets. Now, another reason for this is because the bond market is moving up. That's creating lower yields, which is essentially positive for equities as well. And weaker data should also essentially mean that the Fed should lower rates. And with Trump coming out with a spending bill of more spending and possible rate cuts, this is all positive for the equity markets. So you could see this scenario of the boy who cried wolf, where the markets just completely ignore the boy crying wolf, which is, look at the data, it's getting worse, it's getting worse, it's getting worse, and the markets continue to ignore it. And we've seen this previously many times in past recessions, where you get the final melt up before the big plunge, right? So we might see that again, where we continue to melt up. Boy who cried wolf. Stocks ignore it. Who cares? You're spending. The government's spending. Consumers are still spending. Money is still flowing. Yeah, the economy is weakening. Who cares? Prices are moving up. Whatever. Prices are moving up. That means inflation's moving up. That means let's park money not in cash or US dollars. Let's park it into some assets that are going to return something to beat this inflation, aka the stock market and other risk assets out there. So this continues to be the theme in the equity markets. But what the economy and the economic data is showing is a completely different story, until the wall finally, until it really truly, when the cracks truly break, then you'll start to see, all of this come tumbling down pretty quickly. But the bond market here is reacting to it in how it should, due to the weak data, and bringing those yields lower. Let's see if that continues to be the theme, and let's see if also we continue to see the data weakening in the coming months. It looks like that's the trend as it continues. Now, let's just talk a little bit about the jobs report if we dive in a little deeper here, the ADP report. So I mentioned that the private employers added which is the ADP report, added 37,000 jobs in May. So when you break this down in terms of an industry sector, that comes out to be 36,000 jobs being added in the servicing providing sector, and that includes trade, transportation, utilities, which was actually they saw some lower jobs of negative 4,000, so job losses. Information sector, servicing sector added 8,000 jobs. Financial activities added 20,000. Professional business and services saw negative 17,000, so basic job losses. Education, health services about negative 13,000. Leisure, hospitality, 38,000 jobs being added, and other services 4,000 jobs being added there. So total service providing jobs added about 36,000. Now the goods producing sector got hit pretty hard with total minus 2,000. So they're seeing some job losses there, with the natural resources mining sector being hit with all the tariffs and whatnot, of minus 5,000 jobs. Construction actually added 6,000 jobs, and manufacturing saw minus 3,000. Hence, you're seeing the manufacturing data weaken and weaken. When we look at based on the establishment size from 1 to 19 employee kind of companies, they saw about minus 6,000 jobs, and 20 to 24 employee companies saw minus 7,000. So total small establishments saw about minus negative 13,000 jobs. Medium establishment companies saw an added 49,000, where the firms that hire 50 to 249 employees saw addition 51,000 jobs being added there. Now when you go higher than 249, between 250 to 499, which is still considered medium-sized establishments, they saw minus 2,000. And the large establishments, the big companies, 500 plus employees, they saw negative 3,000. So more of the jobs being added, you could say, in the medium-sized company, but the small and the large are seeing some declines there for the month of May. Now, in terms of the medium change in your pay, in the annual pay, the job stayers, they saw basically an increase of 4.5% in the pay, and the job changers, obviously makes sense, saw an increase of about 7% there. So overall, when you put all the data together, it still comes out to be 37,000 jobs being added. But when you look at the trajectory and where it's headed, we're going from hundreds of thousand jobs to 80,000 jobs being added to 60,000 jobs being added, now 37,000 jobs being added. And when you break it down, you're seeing certain sectors, certain sizes of companies reduce the employees and add employees here and there. And the trend continues where you're getting higher prices, more pain for consumers, dialing down on their spending in certain areas, tariffs, higher costs, and thus the growth weakening. Thus, this is why you're getting the job market weakening further and further and further. And the trend will continue. It just takes a matter of time. So, very interesting here. Let me know what you guys think and how you think of when it comes to all of this with the jobs data and the growth data. And let me know what you guys think of the upcoming non-farm payrolls report that's going to come Friday. Are we going to see a weak report? Are we going to see, a strong report? And what do you think Trump's going to say? Is he going to blame Biden for it? Or is he going to take credit if the jobs numbers come in stronger and say, hey, we got a good NFP report and it's all because of me? But if it's a weaker number, probably we're likely to see him blame Biden all over again. Like just this morning when the ADP numbers came out, he blamed Powell and said Powell should be cutting rates more than what is expected, and saying that Europe has already cut 7 times and we should be cutting way more. Obviously, every time something bad comes out, he's pointing the fingers elsewhere. And if something good comes out, then he says it's all because of him. So, very funny, very interesting. But what's not funny and what's real is that the economic data is telling a very different story while the equity markets continue to melt up. So anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified next video, and I'll see you guys around. Cheers. Bye.